Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, markets have felt heavy this week. Not panicked, but definitely uncomfortable. Profit taking everywhere, leadership wobbling, yet the macro data hasn't collapsed. What's really going on?
Uncomfortable is the right word. What we're seeing is a market that's lost its tolerance for disappointment. Not bad news, just less good news. Only a couple of weeks ago, economists were upgrading growth forecasts, and the soft landing narrative was back in full force. But markets ran ahead of themselves. So now, even a gentle cooling in the data is enough to trigger profit taking across the year's winners. This isn't fundamentals breaking, it's expectations being reset.
And the data really does look more like cooling than cracking.
Exactly. U.S. jobless claims have ticked higher, but they're still below last year's levels. Services remain firmly in expansion. Europe's story is similar. The ECB held policy steady and signaled inflation is likely to undershoot target for the next couple of years, which tells you rate cuts are coming, but not urgently. Even Japan is a fascinating case. Household spending is weak, but policymakers are openly talking about moving away from deflation and normalizing rates. When the Bank of Japan starts hinting at further hikes, you know the global policy backdrop has shifted. Markets are adjusting to that reality, and they don't love it.
One of the striking features this week has been how sharp the unwind has been in last year's winners.
Yes, and the key issue wasn't direction, it was scale. A lot of trades simply went too far, too fast. Precious metals are a good example. Gold and especially silver had become crowded portfolio insurance trades, fueled by retail buying and leverage. When the unwind came, it was violent, not because the long-term case disappeared, but because positioning had become extreme. The same applies to industrial metals like copper. The fundamentals are still there. Electrification, AI-driven power demand, limited supply growth, but prices overshot. Volumes exploded. Now we're seeing a healthy pause, not a reversal. This is excess being wrung out of the system.
We've also seen brutal stock-specific moves beneath relatively calm index levels.
And that's where the indices are misleading. The Nasdaq might only be down modestly, but beneath the surface, the rotation has been savage. AMD falling more than 15% in a day is a perfect example. Nothing broke, but expectations were sky high, and guidance didn't clear the bar. Contrast that with Alphabet, which rallied on strong revenues, profits, and a credible AI investment plan. That tells you something important. AI is no longer one unified trade. The market is separating long-dated stories from platforms already monetizing at scale. Capital is flowing toward quality, cash flow, and balance sheet strength, and away from fragile valuations. Dispersion is back, and that's healthy.
Oil has also cooled a little this week.
Yes, but importantly, without breaking. WTI and Brent have given back some geopolitical risk premium as traders fade tail risks rather than question the underlying tightness. Supply discipline remains, cash flows are strong, and energy equities are still behaving well. At the same time, the scale of investment tied to AI infrastructure, power, cooling, cabling, data centers, continues to grow. This isn't just a tech story anymore. It's a physical build-out, and that keeps real assets and commodities relevant.
So when you step back, what's the big message from this week?
I'd sum it up like this. The market is relearning discipline. Easy trades are being challenged. Crowded winners are being trimmed. Valuation matters again. Cash flow matters again. Balance sheets matter again. This isn't fear. It's digestion. Growth is still there, but capital isn't free. Policy is still supportive, but it's no longer rushing to rescue markets. And in that environment, the winners won't be the loudest stories. They'll be the businesses and portfolios built to absorb volatility without losing their footing. Early 2026 isn't about markets breaking. It's about markets growing up.
That's it for this week. Stay tuned for more insights next time.